Let's lead in improving the quality and standards of the financial profession.
Keep your abreast of financial innovations here and abroad.
Be known for our integrity and professional excellence.
Let's always put investors' needs above our own.
Push for financial literacy.
Provide service to the investors through the selection of the best managed funds of the year.
Let's build trust in our industry.
Advocate on behalf of industry issues.
Convince trust and asset management companies to adopt the Asset Managers Code and the Global Investment Performance Standards.
Let's put ethics at the heart of everything we do.
Talk about ethical decision-making.
Encourage ethical behavior and be really passionate about it.
Let's create an environment where investors' interests can flourish.
Markets function at their best and economies grow.
For the ultimate benefit of the Philippine society.
I am Chris Arceo.
Mark Yu.
Erwin Ocampo Avante.
Rob Ramos.
Sandra Aralia Gonzalez.
Mark Ilaw.
Kate Burgos, and I am CFA Charter.
We
measure up. Join us.
Let's measure up.
CFA Institute is a global association of investment professionals that sets the standard for excellence in the industry. Since its foundation in 1947, CFA Institute has aggregated about 100,000 members and candidates in the fastest growing region, Asia Pacific. In response to extensive demands, CFA Institute has created the Asia Pacific Research Exchange, or ARX, an online research platform focused on investment management. Covering 18 major markets in the region, ARX provides content on over 20 investment subjects, including within the fields of knowledge application, academics and regulation. Leveraging the extensive membership network and industry resources of CFA Institute, ARX is a sharing platform, feeding its users a great deal of first-hand industry news. ARX is also a learning platform, as a large number of high-quality research papers enable its users to stay abreast of all popular investment topics in the region. Beyond all that, ARX users can hear each other and find industry peers by publishing articles and research reports, making it a highly interactive platform. For more details, please visit www.arx.cfa. ARX is your preferred financial research platform for sharing, learning and interacting.
Good afternoon, everyone. Welcome to the Investor Series Derivatives or Structured Notes webinar. Thank you for being here today with us. My name is Alvin Tan from CFA Society Philippines, and I am your host for today's event. We would like to take this opportunity to recognize our annual corporate sponsors. Platinum sponsor, Sea Oil Philippines Inc. Silver sponsors, BDO Capital, Coco Life Asset Management Company Inc. and FTI Consulting Philippines. Bronze sponsors, APS or AP Securities Incorporated, DBP Daiwa Capital Markets Philippines, and Papa Securities Corporation. And our event partners, FMAP, MART, and Sharefield. To formally welcome us all, may we please have the President and Chairman of CFA Society Philippines, Dr. Robert Ramos, CFA, SAYA, CIPM.
Thank you, Alvin. I usually open a lecture series by saying that I've always believed that even during the most trying of times, every individual, any individual, can find many ways to improve. Obviously, for us, obtaining the CFA charter is one path to such improvement. Continuous learning is also one sure way to personal progress. In this lecture, I do hope that you pick up a lot of pointers on how you can traverse the road to self-improvement while scaling the road of moving up the corporate ladder. Thank you to our esteemed speaker. Thank you, Tony, for sharing your time. And thank you all for attending this webinar. Alvin, back to you.
Thank you, Dr. Robert Ramos, for the warm welcome. Again, to all the people right now here in our online event, welcome to the webinar. This webinar is brought to you by CFA Society Philippines. Joining us today to talk about derivatives or structured notes is the Director, Head of Financial Institution Sales in Standard Chartered Bank Philippines. She established her footing in the banking industry for 14 years, wherein she held various posts such as derivatives and structured products chief dealer in BDO Private Bank, head of corporate sales in Security Bank Treasury, and vice president handling financial market sales in ING Bank, Manila branch. Further to this, she has always been an advocate for continuing learning. She has been a resident resource speaker for Ateneo CCE, handling topics such as financial risk management, fundamentals of derivatives, and business of treasury banking series. She is also a resident review instructor in the CFA Level 1 review class, handling fixed income and derivatives modules. She graduated with a master's in applied mathematics, major in mathematical finance from the Ateneo de Manila University last 2008. She is a chartered financial analyst, a certified treasury professional, and an SEC certified fixed income and equities salesman. Without further ado, may we call on Ms. Marie Tony Bautista, CFA.
Thank you, Alvin, and thank you, Rob, for the warm welcome. So I thank the participants for taking the time to further your learning. Admittedly, if I were to compare various products available in financial markets now, I would say that most likely like derivatives, structured products, crypto, these would be what we call non-traditional products. And that's why we would normally have a lot of webinars, specifically talking about these types of products. Admittedly, when I had this brainchild of having like the investor series for the CFA Society Philippines, given that I also head the continuing education committee in the society, I really wanted each webinar to be like a webinar for dummies in a way, like bird's eye view discussion on what the products are, such that if and when you find that interest to learn more about the product, you let us know so that we can help you, like we can also build a course specific for CFA Society Philippines to further your learning on this specific topic. So I hope that you joined us in our earlier sessions, and then I hope that you join us in our succeeding sessions as well. The succeeding sessions, it was actually flashed at the start of our webinar for today. So for today, we'll be discussing purely derivatives and structured products. I just handpicked a few products which I think would be relevant, knowing that, of course, the derivatives industry here in the Philippines, we're still at its infancy. So I joined the finance industry back in 2008 during the global financial crisis when everyone hated derivatives. So it was heartbreaking for me because I studied derivatives, and derivatives was really my first love entering into the workforce. So these are the things that I would like to debunk towards within our 1.5 hour session for today. So if you have any questions, just feel free to type them on chat. I would allot time later on to discuss and to answer your questions. Allow me just to share my screen. Okay. I think there's a lag. Okay. Let me just make it wider. Okay. Because whenever I use the slideshow, bigla siya nawawala. Ayaw. Okay. Okay. So maybe I'm having some trouble sharing with the slideshow, so I'll just use my PowerPoint. I'll just make it a bit wider. So for this afternoon, I will of course start with an overview of what derivatives are. So for our first portion of the presentation, I'll be defining what derivatives are. I'll provide to you the building blocks of derivatives, and then I'll also discuss derivatives documentation because it's quite important heading into these types of products in the future. So let me start with the etymology of the word. So if you see the word derivatives, you can see that there's that root word there, right? The root word of the term derivatives is derive, right? So that means that this financial instrument takes value from another asset. That other asset is what we call our underlying asset. So it's not the same as your bonds or your stocks, wherein its value would be the stock price. The value would be a fixed income price. So the value would be FX or dollar peso. A derivative, in itself, it's an instrument which derives value from another asset, and that other asset is what we call an underlying asset. So that would be the first part or feature of what a derivative instrument is. The second is it normally requires no net initial investment at the start, or an initial investment that is smaller than what would be required for other types of spot contracts. So spot contracts would be a fixed income trade, for example, wherein you deal today, settlement will be tomorrow. That would be what we call spot contracts. It would become a derivative, if it is settled at a future date beyond market convention in terms of settlement. So if you deal a transaction on a bond wherein the settlement date will be 1 month from now, 1 month from now, the settlement that is beyond normal market convention of 1 business day for peso bonds and 3 business days for dollar bonds, right? So because it is settled at a future date and its value is derived from the underlying asset, which is the bond, and there is no investment today settlement will happen 1 month from now pa, no? That specific illustration of a forward on a bond to be settled 1 month from now, that would be considered a derivative transaction. So for an instrument to be considered a derivative trade or a derivative instrument, it needs to pass these three features. The first one is that there is the presence of an underlying asset. Second is that today or tomorrow or even the day after, there is no investment or there is no cash out on your end, or the cash out, it would just be a fraction of the principal of the trade. And then third is that it is settled at a future date beyond usual market convention. Now, what are the uses and applications of derivatives? Now, the main use of derivatives would be hedging. What do I mean when I say hedging? This hedging is typically a risk management strategy wherein you actually take out risk. So for our asset manager friends, for example, wherein you have a dollar portfolio, but returns are presented to the client in pesos, right? So you see a mismatch, right? So the assets, they are denominated in dollars, but the results are presented to you in pesos. So because of this mismatch, you know that you are exposed to foreign exchange risk, right? So we have various hedging instruments, which are derivatives, which can mitigate your FX risk exposure. Right? So derivatives are there in order to mitigate your risk exposure. And this is the main objective in entering a derivatives transaction. Now, the second use and application of derivatives would be speculation. I don't really like to use the word speculation because it implies risky transactions na parang you're gambling your money in a way, right? But for me, speculation, the more proper term is you taking a view, right? So if you have a view, for example, that 1 month from now, the underlying asset price will move higher. For you to monetize this view, what you can do is that you can lock in your buying price for that underlying asset today for settlement 1 month from now, right? So it is a strategy of taking a risk position or a market view intended for you to gain money or for you to gain profits in your trade. Now, usually, using regulations, what would be in a way recommended by our regulators is that we use derivatives only for hedging. But for the purposes of proprietary trading, for example, wherein you have your financial markets in treasury, which is their main business, which is proprietary trading, they are allowed to take positions using derivatives. Now, the third application of derivatives is what we call arbitrage. What do I mean when I say arbitrage? So medyo, it's a bit intimidating, the term. Arbitrage means riskless profit. So there are instances, and I'll show you later on, if I use dollar peso, for example, we actually have two types of markets. So we have the onshore market and we have the offshore market. And the main reason why we have the offshore market, because previously the peso was a restricted currency, right? So before, actually up until now, it's still restricted. You're still not allowed to take out pesos outside of the Philippines. But now we have non-residents. So you have the likes of BlackRock, for example, mga ganyan, you have big hedge funds offshore. They can actually buy pesos now. So, but previously that's not allowed. So that is why we actually have two types of curves. We have the onshore curve, which is trading here in the Philippines. And we have the offshore curve, wherein the usual counterparties will be offshore banks. Now, because of these two curves on the same currency pair, there would sometimes be situations wherein there are price dislocations. So sometimes mas mura yung onshore curve, sometimes mas mahal. So because of this, you can actually enter into opposing trades. So you can, for example, buy onshore 1 month forward, sell offshore 1 month forward. So that means your risk is negated. So there's no risk in your position. But given the price dislocation or price disparity, you can you can book income. And that is what you call arbitrage profits. So that is one of the main application as well of derivatives. Derivatives would allow you to take advantage of arbitrage opportunities because we have derivatives transactions which would not require physical delivery of transactions. No? So that means suklian lang tayo. No? And that would allow, of course, shorting in a way. So it can help in maximizing trading profit. So these are the three main applications and uses of derivatives, but the main use would be hedging. Later on in our webinar, I'll also be showing you structured notes. So what are structured notes? Effectively, they are a deposit or a fixed income security, and then you embed a derivative transaction. That derivative transaction or derivative instrument would provide you a kicker, allowing you to book yield enhancement in the form of a higher yield in that structured note versus your usual time deposit or fixed income instruments. Now, moving on to the building blocks of derivatives. Now, if you read through textbooks, you may find that there are 4 building blocks of derivatives. But I usually omit one because they're essentially the same as forwards. So the first one are forwards, second would be swaps, third would be options. So these are the 3 building blocks. So in the next few slides, I'll discuss what these are. Now, what are forwards? So forwards they're effectively bilateral agreements. So what do I mean when I say it's bilateral agreement? It means that it is an agreement between 2 parties. It's an agreement between 2 parties to buy or sell a specific asset at an agreed price. That agreed price is what we call our forward price for settlement at a future date. And that future date is what we call our forward date. Now, we have various types of forwards depending on the underlying. So again, the underlying, that is where the derivative instrument derives value from, right? So we have bond forwards. So an example would be an underlying asset would be a specific ROP bond. An ROP bond would be a dollar-denominated bond issued by the Republic of the Philippines. And then we would also have forwards on interest rates. An FRA would normally have an underlying asset, which is LIBOR, your London Interbank Offered Rate. And then third, and the most popular among all of these types of forward contracts would be FX forwards. What do I mean when I say FX forwards? It just means that it is a forward wherein your underlying asset would be a specific currency pair, such as dollar peso, euro peso, for example. But settlement, it will be beyond market convention. So for dollar peso, for example, market convention in terms of settlement would just be up until T+2. Anything beyond T+2, that's already considered a forward contract. So that's how we usually differentiate spot transactions versus forward transactions. Now, the second building block of derivatives, actually this is the third. The second building block of derivatives would actually be futures. Futures and forwards, they are economically the same. The main difference is that forwards, they trade over the counter. What does that mean when I say over the counter? It just means that we don't need to go through an exchange. So unlike Philippine stocks, listed Philippine stocks, wherein you would need to go through an exchange for you to deal and for you to settle. Forwards, you don't need to go through that. You just need to call your friendly bank and then ask for a price, right? And then once a deal is done, then we just give you the back office confirmation, and then settlement will occur on forward maturity date. Now, for futures, there's a presence of the exchange. So that means that you would need to transact in an exchange. So that's how it is different. So here in the Philippines, we don't have a futures exchange yet on derivatives. So all of the actually, it's not all. Majority of the derivatives transactions dealt by banks, by insurance companies, by asset managers, by corporations here in the Philippines, they are transacted over the counter. Now, moving on to the third building block of derivatives, I'm now moving on to swaps. So from the name in itself, you know that swap, ano ba layman ng swap? It's an exchange, right? So it's still an agreement between 2 parties, to pay or receive a certain specific asset, and at a certain price, and that certain price is what we call our swap rate. So effectively, there would be a series of exchanges in the future. We have several types of swaps depending on the underlying asset. Again, if your underlying asset would be a specific currency pair, that's what you call an FX swap, and a cross-currency swap. So later on, I'll be discussing specific examples so that you can have like a better appreciation on these types of products. We also have swaps on interest rates. And this is one of the more popular products also here in the Philippines. Here in the Philippines, the most popular types of products would be FX forwards, FX swaps, cross-currency swaps, and interest rate swaps. And then the third type of swap would be a credit default swap. Now, what is a credit default swap? The way I think of credit default swaps is that it's similar to insurance. Whenever you buy insurance, you need to pay premiums, periodic premiums, such that, and technically you're insuring yourself, such that if, for example, you die, then your beneficiaries would be able to get like a lump sum or X amount of money for a specific period. That's the same for a CDS. There is what we call a reference entity in a CDS trade. So let's assume that your reference entity is the Republic of the Philippines, or ROP. So if, for example, I buy CDS, I buy an ROP CDS, that means that I am protecting myself on the possibility that the Republic of the Philippines will default. Because if the Republic of the Philippines defaults, that would mean that I will get the entire principal back. Now, later on, I have a structured note, which we call credit-linked note. And the embedded derivative in the credit-linked note would be a CDS. If you buy an ROP CLN, for example, what you are doing is that you are selling protection on the Republic of the Philippines. So baliktad naman yung view mo, you would only do this trade if you have a view that the Republic of the Philippines will not default during the life of the note. Because effectively, ikaw yung nagbenta ng insurance, right? So if, for example, the reference entity defaults, that means that the protection buyer in the CDS can claim the entire principal from you. Right? So these are the things that we will be discussing throughout the remainder of our 1.5-hour session for today. Now, the fourth building block of derivatives would be options. I don't have much slides on options, so this is my only slide. The first three building blocks that I mentioned, forwards, futures, and swaps, these are what we call forward commitments. That means that the main reason why there are commitments, there are obligations. That means that wherever the underlying asset price will be in the future, on your forward settlement date, for example, on your future settlement date, or on your swap settlement date, you cannot walk away from the transaction. You're already tied to that agreed swap fixed price, that agreed FX rate, that agreed bond price, for example. This fourth building block of optional, which is options, this is not an obligation nor a forward commitment. This is a contingent claim. So this means that if you are a buyer of an option, you don't have the obligation to buy or sell the underlying asset in the future. You only have the right. So that means that if it's better for you to buy the underlying asset outside of the option, you can just let the option expire, and buy or sell the underlying asset at prevailing market. That flexibility is not open. It's not available for forwards and swaps because, as I've mentioned, wherever the underlying asset price will be, you are required to fulfill your side of the obligation in the derivative transaction. Now, similar to forwards and swaps, we also have FX options, wherein your underlying asset would be a specific currency pair. We would have interest rate options, ang tawag sa kanila caps and floors, And then we also have bond options, wherein your underlying asset would be a specific bond or series in terms of bonds. So these are the building blocks of derivatives. So I just handpicked a few of these for our 1.5-hour session this afternoon. Now, before I leave overview, I also wanted to share, of course, some notion and well, some terminologies in derivatives documentation. Now, take note that given that the transaction in itself, no, by definition of derivatives, is that it is settled beyond market convention. This exposes both parties to what we call counterparty credit risk, because the longer the tenor from deal date up until the settlement date of the transaction, the bigger the chance that your counterparty may default, no, prior to the maturity date or the settlement date of the derivatives instrument. So because of this, no, it has been globally accepted that for us to be able to deal derivatives, we need to ensure that we have agreements in place. And the most common type of agreement is what we call the ISDA Master Agreement. So ISDA stands for your International Swaps and Derivatives Authority. So they have their own template. And then you can negotiate with your counterparty on several provisions in the ISDA. Now, sometimes, no, some of your counterparties would also require what we call credit support annex. No, so for me, it's a step up. No, I've been mentioning the concept of pre-settlement risk. No, having the ISDA in place would protect you from pre-settlement risk, and that is the risk that your counterparty may default prior to the maturity date of the derivatives contract. However, no, it doesn't really protect you from the mark-to-market swings, right? So if, for example, your counterparty defaults, no, then you would just be left claiming, no, what you can after your counterparty would be able to sell off their assets in a way after bankruptcy proceedings, right? Having a credit support annex in place, no, this would allow what we call daily margining. So on a daily basis, derivatives transactions are normally booked as held for trading instruments. So when I say they are held for trading, following accounting rules, they would need to be marked to market daily if you don't apply hedge accounting. So if, for example, your counterparty is booking a loss and you are, let's assume that I am dealing with a counterparty bank. I'm booking a gain, my counterparty is booking a loss, right? So we know that that concept, right? So it's a zero-sum game in finance. So if, for example, something happens to my counterparty tomorrow, no, that would mean that my derivative transaction with them, it would have been canceled already, right? So if the trade is canceled, then I would have lost my gain, right? Having that CSA or credit support annex executed between the two counterparties, no, would allow me, given that I'm booking a mark-to-market gain, that would allow me to call on my counterparty. That's what you call a margin call. No, I can ask them to deposit dollar cash to my account in the amount of my mark-to-market gain, such that if, for example, my counterparty defaults the next day, no, I already am holding the cash, right, the margin that they've posted. So this would protect my mark-to-market gain, right? So in a way, we have all of these documentation in place in order to protect ourselves from the possibility that our counterparty will default prior to the maturity date of the derivatives trade. No, given that the nature of derivatives transactions is that the tenor is usually longer, no, than your usual spot transactions. So these are standard; they are widely accepted by the market, no. And because of this, no, it's very efficient in terms of documentation. And I think the main use and the main rationale for having these docs in place, no, would be a credit risk mitigation, as I've described earlier on. So take note that if you deal outright derivatives, so that means magdi-deal ka lang ng FX forwards, interest rate swaps, credit default swaps, or cross-currency swaps, you need to have some sort of derivatives documentation in place. However, if you buy structured notes, no, and that's the beauty of structured notes, no. Structured notes, I mentioned, it would be just a deposit and a fixed income asset, and then you embed to that deposit or fixed income asset a forward, you embed to that a cross-currency swap or a credit default swap. So as it is, no, it is embedded in a note. Given that you are an investor, you just buy the note. No? You don't need derivatives documentation there, and that's the beauty, no, of you being able to buy structured notes in this market, because that would allow you to effectively escape no derivatives documentation. That would be sometimes very taxing no, on your own legal and compliance. Okay. So before I move on no, to various types of derivatives, I wanted to probably check no, if you have any questions. Okay, I don't see anything. Okay, none so far. Okay. Thank you. I see a few students. So, well, I hope that because what I will be teaching you, it will be practical illustrations. So I hope that you're able to apply those also into theoretical concept which you've been learning now. Okay, so for the remainder of our session, I will just be discussing 4 outright derivatives no, in detail. So this would be FX forwards, FX swaps, cross-currency swaps, and credit default swaps. Yes, correct. Correct, Rob. So it's International Swap Dealers Association. That's ISDA. So they are effectively parang sila yung nag-release ng standardized documentation for derivatives transactions. So as it is, no, I just selected these 4 types, but again, no, feel free to provide like feedback to our staff if you want to learn more about various types of products. No, we can easily discuss further and then open another derivatives and structured products webinar later on. So what are forwards? So for me, this is the most basic derivative instrument, no, which you can actually see in the market. No? So what is an FX forward? An FX forward, I mentioned earlier, it's still a bilateral agreement wherein you are exchanging 2 currencies and at agreed rate, which we call forward rate. And that forward rate, no, how we compute for that, take note that the forward rate, it is different from your spot rate. Mainly because it takes into account what we call cost of carry, and it takes into account time value of money. Because effectively, no, if you think about it, you buying dollars now, that would require you to shell out pesos today, right? Versus you buying dollar peso 1 month from now. That would require you to shell out pesos 1 month from now pa. Right? So if your cash outflow for pesos, it will occur 1 month from now pa. Technically now, you can enjoy the higher interest rate differential. The higher interest rates rather of Philippine pesos versus US dollars, because you can effectively place your pesos for 1 month TD, no? And you can earn that income. Now, there's no such thing as free lunch in finance, right? So we know all of this. So we know that effectively, you buying dollars 1 month from now, assuming same rate, no, it would be better for you to buy 1 month from now, no, because you can place your pesos in a 1 month TD today to mature on the same forward maturity date, no. Because as I've mentioned, there's no such thing as free lunch, no? That cost of carry, that's what you call cost of carry, that would be an add-on rate to your forward rate, no? That's why later on I'll show you that forward rate, so for dollar peso, it's normally higher than your spot rate because we have to factor that in, no? The higher interest rate, no, in Philippine pesos versus US dollars. Okay. So in this illustration, my underlying is dollar peso. Dollar seller is the client, no? Dollar buyer is SCB or Stand Chart, for example. The notional, this has to be agreed on deal date as well, $1 million. Effectively, the client here is locking in, no, his selling rate, no, for US dollars on December 31, 2022 at 56, right? So fast forward tayo, in a way, no? Fast forward tayo December 31. We don't know where dollar peso will be December 31, right? So if the spot rate is less than 56, effectively, if you think about it, gains si client. Because the client was able to lock in their selling rate for US dollars at 56 when the spot rate is below 56 on December 31, right? However, if the spot rate is above 56, the client is booking technically a loss, right? Because the client is required to sell dollars, at the lower forward rate. Because again, the client cannot walk away from the forward transaction. So this would be your payoff diagram for a sell forward transaction. So effectively, what the client is doing here is that he is ensuring that there is reliable cash flows on his part, such that he doesn't need to monitor dollar peso daily up until December 31. He is already happy to receive 56 million pesos against his $1 million on December 31. And that is the main motivation for most of our clients dealing forwards. It's really a hedge for them. So some of our importer clients, they know, for me, like in our FX rate scenario now, dollar peso today closed at 58.49, right? So this is the highest level for dollar peso. Importers would be on the would be more disadvantageous now. So what importer clients would normally do is that they are hedging against this rise in FX rate. And how they do this is that they lock in their buying rate for US dollars today, for example, for settlement in the future, such that if, for example, they may book because as we've seen earlier, as we've seen in this payoff diagram, you can lose in the FX trade, but you have to remember that there is an underlying which you are hedging, right? So and that is the main. That's why in our overview earlier, I mentioned to you that majority of the motivation and rationale for entering into the derivatives is really for hedging and to take out risks. Now we have a variant of FX forward. This is what we call NDFs, or non-deliverable forwards. What is the difference between a deliverable forward and a non-deliverable forward? A deliverable forward means that there is an actual exchange of dollar against pesos. In a non-deliverable forward, suklian lang tayo. That means that the losing party will need to pay the winning party. Now for dollar peso NDFs, convention is that our fixing rate, which will be our determination, which will be the rate that would allow us to compute the NDF settlement amount. It is the fixing, it is the BEP 11:30 a.m. weighted average of done transactions from 9 a.m. up until 11:30 a.m. One business day prior to the maturity date of the NDFs. So let's assume that I'm looking at this illustration, same illustration, but now it's an NDF. Settlement date is December 31, 2022. That means that one business day prior to that, that is our fixing date. So we know that December 30, it is a Philippine holiday, right? So we know that there's no dollar peso trading December 30. So therefore, we move to the previous day. So December 29, yung fixing date nitong dollar peso NDF trade. So again, the way we determine who is the losing party or winning party, it is we need to compare the fixing rate versus your NDF rate. So if the fixing rate is less than the NDF rate, again, gain si client because nakabenta siya at 56 when the fixing rate is actually lower than 56, right? So because of this, the client will be receiving the NDF settlement amount. Now, if the spot rate is above the NDF rate, loss si client. So because of this, the client will need to pay the counterparty the NDF settlement amount. Now, how do you compute for the NDF settlement amount? Let's assume that the fixing rate is at 55. So we compute for the difference between the NDF rate, which is 56, minus 55, And then we multiply it to the notional amount of 1 million US dollars. No? And then if your counterpart is a non-resident, all non-residents, no, technically they don't have any use for pesos. That's why non-deliverable forwards facing non-residents, they need to be dollar settled. So for you to convert your NDF settlement amount into dollars, you need to divide everything by the fixing rate, which is 55. So given that the fixing rate is 55, you know that the client is gaining because the client has locked in their selling rate for US dollars at 56. Right? So because of this, no, SCB is required to pay the client the net settlement amount. Now, the net settlement amount will be 1 million, which is my notional amount. I multiply it by the difference between 56 and 55, my NDF rate and my fixing rate, no? And then I divide everything by 55. And that is equivalent to 18,181.82. Now, in terms of pricing, I also have a few slides here in terms of pricing. I just want to show you know, how we arrive at forward rates. You know. Effectively, you know, there are two types of forwards. A currency pair can either be trading at a forward premium or a forward discount. How do you differentiate the two? You know, a currency pair is trading at a forward premium when the forward rate is higher than the spot rate. So ganun lang siya, premium if the forward rate is higher than the spot rate. Now, a currency pair is trading at a forward discount if the forward rate is less than your spot rate. Now, for dollar peso, it's usually the case that we see forward premium. So that means that your forward rate is higher than your spot rate. So this is an example, no? Effectively, no, the way we determine whether a currency pair is trading at a forward premium and discount is we compare the interest rates of the two currencies. So if US dollar, no, would have a lower interest rate than Philippine pesos, for example, or SGD, then you should expect that the currency pair is trading at a forward premium. So let's assume here that my spot dollar peso rate is at 56.90. 3-month dollar rate is at 2.5. 3-month peso rate is at 3.25. Of course, syempre gumalaw na to with the recent moves by the Fed and the BSP. So as it is, no, assuming that this is the same scenario that we have now, no, dollar peso is trading at a forward premium for 3 months, mainly because Philippine peso interest rates are higher than US dollar interest rates. So again, no, this is where pumapasok yung concept ko earlier that there is no such thing as free lunch. Given that if you are buying dollar peso, no, 3 months from now, your cash out of Philippine pesos will occur 3 months from now pa. That means that you can technically invest your pesos, which is the higher yielding currency, at a higher interest rate, no, than US dollars. So because of this, medyo may gain ka if you're buying dollar peso forward 3 months from now. That gain, no, would need to be factored in the pricing. So that means, so technically it removes the concept of arbitrage, no, in financial markets, because that potential gain, no, that would have been erased because you are now locking in your buying rate for dollar against peso 3 months from now at a higher rate. So that's why, no, if you have a higher currency interest rate, no, that would normally mean that the currency pair is trading at a forward premium, similar to dollar peso. So how do you compute for your forward rate? So I have here a tabular illustration. So let's assume that dollar peso now is equivalent to 56.90. So this means that $1 is equivalent to 56.90 pesos. Okay. Let me just, this is 56.90. Okay. Now, again, what the dollar interest rate is at 2.5%. No? Peso interest rate is 3.25%. So let's compute for future value. So my $1, I will multiply it by 1 plus 2.5% times 3 divided by 12. And this will be equivalent to 1.00625. My 56.90, I will multiply it by 1 plus 3.25% times 3 divided by 12, and that is equivalent to 57.362. My 3-month dollar peso rate is equivalent to 57.362 divided by 1.00625. So this is equivalent to 57.01. So the difference between my future value and my spot, this is currently 11 cents, right? This is what we call our forward points or swap points, right? So this is one way for you to compute for your forward rate. But for me, I would normally have a shortcut. My shortcut is this. I first compute for my swap points or forward points. Kasi mas madali kapag plus or minus lang eh, di ba? So this is equivalent to your spot rate multiplied by what we call the interest rate differential. So interest rate differential, it sounds smart, but it's just the difference between the interest rates of the two currencies. So it's a difference between the Philippine peso interest rate and the US dollar interest rate. I multiply it by number of days in the forward divided by 360. This is my swap points. I know that dollar peso is trading at a forward premium. So therefore, I would need to add my swap points to my spot rate in order for me to arrive at my FX forward rate. Now let's use the same illustration such that I'll show you that it's the same. Spot dollar peso is at 56.90. 3-month peso rate is at 3.25%. 3-month dollar rate is at 2.5%. Interest rate differential would be 0.75%, which is the difference between 3.25% and 2.5%. My swap points is equivalent to 56.90, which is my spot, multiplied by the IRD, which is 0.75%. I multiply it by, in months ko na lang siya, 3 months divided by 12. I will arrive at 0.11. Since I know that dollar peso is trading at a forward premium, I will add 11 cents to 56.90. That would make me arrive at my 3-month FX forward rate equivalent to 57.01. And that is the same as my forward rate as well if I use the long cut, in a way, future value concept or shortcut ako. So you have two ways to compute FX forwards rate in this slide. Now, in practice though, for me, the earlier 2 slides, it's really nice to know. Because in practice, we actually have a curve for FX forwards. So we have bid and offer pricing. So these are all spot swap points or forward points. So assuming that ideal 3 months, I buy 3-month forward. My offer points, so let's assume that I'm the calling party, that means that my counterparty will quote me forward points of 16 cents added to my spot rate of 56.965. So that's how current market works. So we have our run already. So let's assume that may off tenor cut. So let's assume that you want a 1.5 months forward. We can easily just interpolate. Now, in practice, what we normally do is we compute for what we call our implied peso rate. And we will come back to this in our discussion of FX swaps later on. So an implied peso rate would typically, I would still use my shortcut, and for me that's my favorite expression in financial market, in derivatives, in FX forwards. Remember our expression that swap points is equivalent to spot multiplied by the interest rate differential multiplied by the tenor of the forward divided by the number of days in the year. Effectively, if I have spot dollar peso at 56.94, 3-month swap points at 0.14, which is the bid here, 3-month US dollar interest rate, let's assume it is at 3%, I would only be left with one unknown, which is my implied peso rate, right? So I can easily isolate it using algebra. I would just isolate it. And I can compute for the implied peso rate of my 3-month swap points of 14 cents, right? So my implied peso rate is equivalent to my swap points, which is 14 divided by spot. I multiply it by 360 divided by 90. And then, of course, I need to make it in percentage, so I need to multiply it by 100. And then I need to add to that my 3-month dollar rate of 3%. So at 14 cents, no, that implies a peso rate of 3.983%. And we'll use this later on in the concept of hedged investing, no? And in our concept of peso synthetic or peso denominated structured notes. So this is the main concept, because a peso denominated structured note, it is effectively just a deposit with you actually doing a buy-sell FX swap transaction. So later, that would be our next topic and next product under derivatives. Now, I also have a few slides here, so you can take this home. I'll share this to the staff later on. Effectively, an FX forward, we have two curves, as I've mentioned, here in the Philippines. We have the onshore curve and the offshore curve. For the onshore curve, this is regulated by the BSP. Tenors would normally be up to 12 months, and settlement is usually deliverable. So that would mean that there is physical transfer of cash. In the offshore curve, though, it is liquid up until 5 years. The usual counterparties are offshore banks, so non-residents and not based here in the Philippines. Regulatory approval is not required, and settlement is non-deliverable in US dollars. Now, what are the main uses of FX forwards? We would normally use FX forwards for the three rationales that I mentioned. The first one is hedging FX exposures. Our usual customers would be importers. They can lock in their dollar buying rate for future importations via buy dollar peso deliverable forward transactions. We also have exporters or BPOs, which can lock in their selling rate for future dollar export receipts or salaries for BPOs via dollar peso deliverable forward, via sell dollar peso deliverable forward transactions. We also have local asset managers, I mentioned earlier, right? So for local asset managers who are managing dollar denominated portfolios, but their returns are presented in pesos. So they can hedge potential revaluation losses in the event that dollar peso would move lower by locking in their selling rate for US dollars via dollar peso NDF transactions. Bakit siya NDF normally? Because you're actually doing what we call balance sheet hedges and not cash flow nor transactional hedges for these types of transactions. Now, you can also use FX forwards for taking views. So if you have a view that the underlying currency pair will move higher, you can buy forward. If you have a view that the underlying currency pair will move lower, you can sell FX forward. Now, finally, you can also use FX forwards to take advantage of pricing dislocations. So assuming that you comply with regulations, if the offshore curve, for example, is cheaper than the onshore curve, so meaning mas mura yung swap points ng offshore curve versus the swap points ng onshore curve, you can buy 1 month NDF, sell 1 month forward onshore. So you don't have any risk, right? Because it's hedged. You buy offshore, you sell onshore. So the difference would just be the difference between the onshore rate and the offshore curve, and the offshore rate would be your gain, and that is you taking advantage of the arbitrage opportunity. Now, aside from those rationale or uses of forwards, another application that we normally see now is through the use of what we call peso hedge share classes. So these are normally seen in insurance companies. They have their VULs, which are peso hedged, but they are invested in dollar-denominated or global assets. So a peso hedge share class is just a combination of two transactions. The asset manager and the insurance companies, they invest in global assets. They are dollar-denominated. Given that they are dollar-denominated, that means that you're exposed to FX risk, right? Because even if the global asset would gain, no, since you are a peso earner, no, you would need to convert your gains into Philippine pesos, right? So to remove that FX risk, you can embed a dollar peso NDF, which you roll on a monthly or quarterly basis. And if you combine the two, that's effectively a peso hedge share class product. So the main, I think the main advantage of having this product, no, in your own firms is that you would provide your clients diversification and access to global assets while ensuring that they experience minimal FX risk. So investors are able to get exposure to global assets for yield enhancement. Examples of global assets may be any global ETFs, global equity ETFs or fixed income ETFs, global funds investing in gold, in oil, US fixed income, etc. No? Through the hedging mechanism embedded in the product, investors are able to mitigate FX risk exposures from the volatility of the underlying currency pair, such as dollar peso. So investments are effectively protected from potential losses in dollar peso in an appreciating peso environment. Now, the second product for derivatives are what we call FX swaps. So what is an FX swap? For me, an FX swap, it is just a combination of a spot and a reversing forward transaction, right? So this is just a summary slide. Allow me to move on to the next one. So for me, you are buying dollar peso spot and selling dollar peso 1 month from now. So in this illustration, so let's assume that you are entering into an FX swap wherein you are selling spot and then buying the same currency pair 3 months from now. So effectively, if you look at the cash flows, you are selling dollar peso ngayon. That means that there is cash out in dollars and cash in of pesos. 3 months from now, you do the opposite. You are buying dollars, you are buying dollar against peso. So that is cash in dollars and cash out pesos. So if you look at the cash flows in an FX swap, in this FX swap, it is the same cash flows as if you are lending dollars and borrowing pesos for 3 months. Right? So that is the money market equivalent of an FX swap. So that's why FX swaps are usually used by ALM or your asset liability management teams in treasury or financial markets. So it's a borrowing and lending activity. So again, a sell buy. So you have two types of swaps. You can either do a sell buy or a buy sell. A sell buy swap means that you are selling the currency pair spot, buying the currency pair forward, wherein your currency pair can be trading at a forward premium or discount. Or you can do a buy sell. You are buying spot and selling forward, wherein the commodity currency is trading at a forward premium or discount. Now, this transaction would generate either a swap cost or a swap yield. Now, this slide, so technically you have 4 permutations: sell buy, forward premium, buy sell buy forward discount, buy sell forward premium, buy sell forward discount. So how do you determine whether it's a cost or a yield? You should always think forward. Think of what you are doing in the forward leg of the swap. So in our first illustration here, you are selling spot, buying forward the currency pair. The currency pair is trading at a forward premium. So this means that you are buying at a higher rate. Bakit higher rate? You have to remember that that you are buying a forward premium. It is defined as a situation wherein your forward rate is higher than your spot rate. So in this first bullet here, you are buying forward at a forward premium. So that means you are buying forward at a higher rate. Is that good or bad for you? That is bad for you, right? So this means that if you enter into a sell-buy transaction, wherein your forward rate is trading at a forward premium, that would result to a cost for you. Okay. Second, You are selling spot, buying forward, wherein the commodity currency is trading at a forward discount. Think forward, you are buying forward at a forward discount. So you are buying at a lower rate. This is good for you, so this would result into a yield. Third, you are buying spot, selling forward the commodity currency at a forward discount. Again, what are you doing the forward leg? You are selling, no, at a forward discount. So that means that you are selling at a lower rate, which is bad for you, so you are booking a cost. Now, finally, you are buying spot, selling forward the commodity currency at a forward premium. So again, think forward, you are selling forward at a higher rate. So this is good for you, so this should result into a yield. No? So we will use this in the next slide. No, I will show you the concept of what we call hedged investment. No, because it is investor series. So medyo mahaba-haba yung intro natin because I needed to discuss forwards in order for me to discuss FX swaps. No? So in this market rate scenario, no, my client has excess pesos for a month. So easiest way for the client to make use of the excess pesos is to deploy in 1 month TD. Right? So let's assume that the market rate scenario is that the market TD is the 1 month TD rate is at 3.15%. Okay, so effectively that would be my bogey. But of course, since I'm a good salesperson, I would look for other alternatives, right? So I would then look at hedged investment. So what is hedged investment? Hedged investment is composed of a money market transaction, no, and an FX swap. The money market transaction is you lending the other currency, right? So in the hedge investment, I will lend my dollars at my 1 month dollar rate of 3%. Pero take note, wala akong dollars, right? I don't have dollars. So I can generate dollars, no, by entering into a buy-sell swap for 1 month, no, at 0.15 or 15 cents na bid the swap points, and that swap points of course will be quoted to me by my friendly bank. Okay, so again, I am doing a buy sell, no, when dollar peso is trading at a forward premium. Again, I am selling at the forward rate at a higher rate, no, because it's trading at a forward premium. So this means that I am booking a yield in my FX swap transaction. How then do I compute for my yield? We now go back to the earlier discussion on how we can compute for the implied peso yield. My implied peso yield is equivalent to my swap points divided by my FX rate of 56.90. And then I need to annualize it. I need to multiply it by 360 divided by 30. And then I multiply it by 100, making it in percentage. And then I will add to that, no, it's actually 3%. I will add to that, no, my 1 month US dollar rate of 3%. And that would come out to 6.16%. So in this illustration, it shows that it is better for me, no, to deploy, it's better for my client to deploy their pesos for 1 month via hedged investment rather than them deploying their pesos via time deposits. Now take note that you have several documentary requirements that may be required by your friendly bank here, given that you are buying effectively spot, no, on the near leg of the swap. But this hedged investment, no, I think the main issue here is number one, again, you need to present supporting documents on the near leg of the swap. No? And then secondly, again, you need to have derivatives documentation in place prior to you being able to transact in effectively hedged investment. No? A solution for this is you can effectively just buy a structured note composed of the entire thing, right? So this is what we call our peso-denominated dollar-settled note. So it's a structured note composed of a deposit and a buy-sell swap on the part of the client, all packaged into a note. So this is sometimes called like a short-term GPN, peso synthetic note, or peso linked note. So that is how we compute for the implied peso rate. So as it is, this is an example. That let's assume that the note interest rate is at 6%. It's a 3-month note or structured note. So it is dollar settled. This means that at maturity, the client will be receiving the peso notional, which is 56.9 million pesos. I multiply it by 1 plus the note interest rate, which is 6%, and then I multiply it by the day count factor divided by 360. But I need to divide everything by the fixing rate 1 business day prior to the maturity date, given that it's dollar settled. Now, for you to be able to effectively enjoy the full note peso interest, you should have the ability to sell the dollar proceeds of the structured notes at the same fixing rate, thereby making the note peso principal protected. So this is a structured note. So like today, I closed like a 2-month trade at 6%. So it's very opportunistic, given that your forward points offshore, it's very erratic. And normally we would see higher swap points during times of peso weakness, which we saw today. Now, the third derivative which I would like to discuss is cross-currency swaps. Now, what is a cross-currency swap? Effectively, it's just like an FX swap, but it is longer term in nature. So that means that there would be interim exchanges from deal date up until the maturity date of the swap. So we would normally use cross-currency swaps and asset swaps. So what do we mean when I say asset swaps? So effectively, it's just the same as your hedged investment, but instead of you buying dollars via FX swaps and then putting the dollars in time deposit, in an asset swap, you raise dollars via initial exchange in the cross-currency swap, and then you use that dollars to buy a dollar-denominated bond. So in this illustration, so let's assume that the client is looking for a 4-year peso investment. And let's assume that the prevailing 4-year peso government bond yield is at 5.10% gross. So we know that peso government bonds, they're subject to 20% final withholding tax. Now, this is one alternative for your client, but another alternative for them is to enter an asset swap trade with 4-year dollar bonds as underlying. So the asset swap, it will be composed of 2 things. The client will buy a dollar bond maturing 2026, for example, and let's assume that the offer yield is at 3.9%. So since they need dollars in order to buy the dollar-denominated bond, they will enter into a cross-currency swap with initial and final principal exchange, wherein he will pay the dollar fixed rate of 2.125%. This 2.125% is effectively the coupon rate of the dollar bond to SCB, and then they will receive the implied peso fixed CCS rate. So let's assume that SCB quotes them a fixed rate of 3.5%. The differential is the difference between 3.5% and 2.125%. And that is equivalent to 1.375%. How then do you compute for your all-in asset swap yield? Quick and dirty way for you to compute for your all-in asset swap yield is that you start off with the offer yield of the bond. You add to that the interest rate differential, and that would be your asset swap yield in pesos. You will then compare this to other peso investments, so such as your 4-year peso government bond earning you 5.10% gross yield. So this would be a sample cash flow, flow of funds rather, and the asset swap. So the bond, remember that the client is still the holder of the underlying bond. So every coupon payment date, the bond issuer will pay the client 2.125% dollars, and then the client will pay that to SCB. So effectively, this portion right here is the cross-currency swap. The client will be paying SCB 2.125%, and they will be receiving 3.5% peso coupon. No? So this is a synthetic peso asset in a way, an asset swap. You would be buying a foreign currency denominated bond, but you still start out in the investment, no, in pesos. Now, similar to our hedged investing illustration in FX swaps earlier, no, main challenge here in asset swaps is that you need derivatives documentation prior to you entering in the cross-currency swap. A solution, again, is you can buy a peso-denominated asset swap note. Wherein, no, your friendly banks such as SCB, for example, we package the cross-currency swap and the bond in a structured note, and whereby we just pay you 6% peso interest, no, settled into US dollars every coupon payment paid in the asset swap note. So this is an example of structured note also. So again, it's still a bond. I embed to that a cross-currency swap, and I would arrive at my structured note called an asset swap. Now, the final product, no, which I will be discussing, would be credit default swaps. And again, it is my springboard, no, for me to discuss my final structured note also, which is a credit linked note. Now, I mentioned earlier that the CDS is effectively like insurance, no. So in this illustration, no, my underlying or my reference credit is ROP, or the Republic of the Philippines. The protection buyer is SCB. The protection seller is the client. So again, since you are selling protection, ikaw yung makakatanggap ng CDS premium periodically. And that would be yield enhancement on your part, right? So let's assume that the notional is 10 million US dollars and the tenor is 5 years. The CDS spread, let's assume, is 110 basis points. So what will happen is that as long as the Republic of the Philippines does not default during the 5-year period, the client will just need to pay periodic interest to SCB. No? So for ROP CDS, the periodic interest is normally 1% per annum. Since 110 basis points or 1.10% yung CDS spread dealt, no? The 0.10%, it will need to be paid upfront by the buyer, by SCB to the client. Now, if, for example, there is credit event, something happens to the Republic of the Philippines, no, then the CDS premium payments will cease, no, and the client, who is the protection seller, they are required to pay SCB 10 million US dollars, assuming that it would be settled via physical settlement. So effectively, no, if you have a view that the ROP will not default, no, effectively you can sell CDS and then you can just enjoy receiving the premiums up until the end of the life of the CDS. Now, a credit-linked note is effectively, no, a fixed income instrument. So let's assume that it's an SCB or Standard Chartered Bank credit-linked note. It is a fixed income instrument issued by SCB, and then you embed to that a sell CDS position. No? So as it is, the kicker here would be the CDS spread. And now, for example, just yesterday, I saw that yields have significantly improved in CLNs, like a 1-year ROP CLN, no, it would yield you about 5.10% dollars. So that would be about 100 basis point pickup, no, versus US Treasury. So I think some of the clients are just waiting for when the Fed may stop hiking rates, no, and then that's when they would consider investing in these types of instruments, no, given the significant pickup that we're seeing already in structured notes. Now, the key risk here for credit-linked note, again, would be the credit event, such that the reference entity may default. Of course, we don't know what will happen. No? If a credit event occurs, principal would be at risk, no, in a credit-linked note. So that means that you are at risk of losing your principal to the structured note. Now, as I mentioned, this is just a slide, no, on the indications for credit-linked notes. No? So it has gone higher. So I prepared the slides early September. Now, for 1 year, we're at 5.10%, as I've mentioned. Now, I will end the quick investor series on derivatives and structured notes with regulations. For derivatives and structured products, given that they're more complex than plain vanilla fixed income and equities, we have specific regulations by the BSP covering these types of products. And this is BSP Circular 1119 and 594. Under these circulars, you will see that there is a requirement for banks to ensure that we have ample product disclosures prior to a client investing in structured notes and derivatives. And then aside from that, we should have a robust client suitability process, whereby in the client suitability process, we gather information on the client, such as their financial experience, their net worth, their ability to withstand losses. What normally happens here is that after we assess the client, we would determine whether they are conservative type investors, moderate investors, or aggressive investors. And then depending on their classification, they would have specific products, including structured notes that may be offered to them. So this would ensure that there's no ops risk on suitability risks, which can lead to reputational risks later on. And I think that was the main motivation why the BSP released Circular 594 back in 2008, right at the smack of the global financial crisis, because back then we encountered a lot of backlash, negative reaction from high net worth clients, and they were claiming that they did not know that the structured note that they bought may result to their principal being at risk. So these were the controls set up by the BSP after what happened in the global financial crisis of 2008. So we have the client suitability process. And then aside from that, we need to be able to ensure that all of the risks in the product, they are properly disclosed to the client. That's why we would normally make them sign or acknowledge what we call risk disclosure statements prior to dealing derivatives. So that actually ends my quick presentation on derivatives and structured products. I have a few minutes left for questions. So I'll pass on to Alvin. Alvin, I think you're...
Yeah. Thank you, Ms. Tony. Thank you very much for that very insightful and meaty discussion on derivatives and structured notes. So at this point in time, we'll now proceed on the Q&A session. Please write your comments or questions to our speaker. You may utilize our public chat space, or you may click that raise hand button so that we could call on you and ask your question. Our speaker would definitely love to answer your question. All right, so I see one here from Monzen. How do you find liquidity in structured products ever since the pandemic? Has it recovered or not yet?
Actually, now, Monzen, I think it has worsened. Well, technically, if you think about it, because we have rising interest rate environment now, right? So for cross-currency swaps, we would normally see wider bid and offer spreads now, mainly because of that risk that is present now. So it's not really because of the pandemic per se. I think it's really because of the pace of the hikes of global central banks, and we don't know when they will end. But as it is now, I think the main the key takeaway that I'm seeing, the observation that I'm seeing now, is I'm seeing more and more interest on structured notes, mainly because the starting point, as I've mentioned, the starting point would normally be the funding rate or the deposit rate of the bank issuing the note. Umakyat na kasi yun right? So so that would be your base case, and then you add to that the kicker, which is your CDS spread, which is your interest rate differential, for example. So because your base rate has significantly gone higher, we're now seeing a lot more interest from asset managers, from insurance companies, from retail clients as well, and from banks in looking at probably just short-dated structured notes for now, given that they still don't know when the Fed will pause in their rate hiking cycle. No, so I hope I was able to answer that. No, in terms of probably unwinding, because that would normally be one of the main questions, no, for structured notes, how easy it is to liquidate or unwind a position. That's why you would have prior to you investing, you would normally look at the track record of the issuer of the note. Do they have a strong derivatives book, or do they have a strong presence in the rates space or in the credit space? Because having that ability to take on, because of course you won't be able to find like the opposite side right away. Most often than not, if for example you are looking to unwind a structured note, no, your friendly bank would provide you an unwind price, and they will hold on to the position, no, born because of that unwind. So the liquidity would still be there. I think that would be dependent on the institution issuing the note.
Great. Thank you, Ms. Tony. I have here another question, this time from Paulo Narciso. What structured products are popular now?
Yeah, so I think the most popular POW would still be the peso-linked notes, the peso synthetic notes, because it's short-dated. In a rising interest rate environment, people would want to keep their investments short-term. So before, our minimum for the peso-denominated notes would just be 1 month. Now, we're seeing interest from clients no as little as 2 weeks, 3 weeks. Because they just want like short-term deployment of their excess funds. And then aside from that, no, as I've mentioned, it's very opportunistic. So if we see levels at 1 month to 3 month levels at 5% to 6%, we normally see a lot of interest there.
I'm just curious, if in terms of the requirements needed to invest in structured notes versus derivatives, are there any difference there?
Normally none. For us, there's no difference, because the way we think of structured notes is that it's just a fixed income instrument, and then you embed to that the outright derivative. So the way we profile our clients, so in terms of their client suitability process namin, Alvin, if for example you can deal a cross currency swap outright, no, then that means that you can also deal an asset swap. That's how we would normally think about it. It makes sense also because it's still an embedded outright derivative anyway in your structured note.
Right, understood. All right, there's another question from Dr. Robert Ramos. Are IRS and CCS more popular now?
It actually is. I would want to answer your question, Rob, into, because dalawa yung main clients for cross-currency swap. The first one would be the corporate hedgers. So these are the clients with dollar-denominated loans, for example, and they want to convert their dollar-denominated loans into pesos. Now, the second type of client would be the asset swappers, right? So these are the investors looking for other alternatives for peso investments. Unfortunately now, the asset swappers, they're a bit sad, mainly because of the narrowing interest rate differential. Because we know that the pace of the hikes of the Fed, it has been faster than the pace of the hikes of the BSP. Right? So because of that, no, the differential, previously we're at mga 2.5%, 2%, right? So now that the Fed hiked by 75 basis points and the BSP hiked by only 50 basis points, we're now narrow. So the asset swappers, they're not as happy, no? But on the flip side, the corporate hedgers, they're now happy because of the narrow interest rate differential. No? So that would allow them a peso fixed rate, which is potentially lower than their outright peso rate if they were to borrow outright pesos.
Right. Thank you, Ms. Tony. Another question from Monzen. What do you think regulators should focus on regarding structured notes?
This is a very good question, Monzen. No? For me, I think the main issue back then is that we didn't really have regulations on ensuring that clients are suitable clients to more complex products. Now we have that. You know? I think now regulators would. I think they should because they released BSP Circular 1119, which is supposedly an amendment to their 2008 Derivatives Circular of 594. I thought it was a relaxation in a way because asset managers, no, insurance companies, they're all holding on to huge amount of cash, right? And they're just looking for assets to deploy these excess cash. But unfortunately for me, like the new circular, it wasn't really that helpful for them. So for me, the focus of the regulators now is really more to help the development of the derivatives market. Because when I started in 2008, there have been talks of a derivatives exchange back then already. So I'm already 14 years into the business, and up until now, the talks are still there, but there's no traction really. So I think it's really, the focus now is, it's not more on client suitability and client protection, because I think we have that already. It's really more, I think we need support to develop the derivatives market here in the Philippines for us to be at par with the US, with Hong Kong, and with Singapore.
All right, thank you, Ms. Tony. Any other questions from our participants and audience? Maybe just a last question. So since you've mentioned about already having discussions with regard to development of derivative market, in your view, what do you think would be the projection of the derivatives market in the Philippines? How long it will take for us to be at par with the other derivative markets already stable?
That's a very hard question, Alvin. But I'm hopeful. But I think, like, because we have three main regulators here in the Philippines. We have the BSP, we have the SEC. Actually, four. We have the BSE, and then we have the IC. Right. So for me, it involves just coordination among them. You know? So I can see that the IC is very forward-looking. I see that they're very forward-looking in a way that you can easily write to them and then ask them if you can invest in a certain structured note, they will approve. And that makes it easier for insurance companies versus, for example, trust departments, wherein we need to comply with the circular. Anything outside the circular, we need to apply for a derivatives license. So I think it all starts with coordination, and then probably having the same process, no, among these four regulators. And well, for me, the products are there because, like for example, for banks such as myself, now I work in a bank, I see a lot more complex derivatives being dealt by corporations versus asset managers, when I know, of course, we have a lot of smart people in asset management, right? Insurance companies who understand the product, but they are constrained with regulations. So I think the knowledge is there. It's really more regulatory coordination, which I'm hoping that we'll see improve in the next 3 to 5 years.
Understood. Again, thank you, Ms. Tony, for sharing your knowledge with regard to derivatives and structured notes. So to our participants, please turn your attention to the screen for the QR code of our online evaluation. Please take time to answer the survey. It will take 1 to 2 minutes for you to complete that one. Last but not the least, let's turn on our videos for the photo opportunity with our guest speaker, Ms. Tony Bautista, for today. So may we request everyone to please turn on your cameras so we could have this photo opportunity with Ms. Tony.
Si Precious ba?
Yeah, just count 1, 2, 3, Alvin, and we'll take.
Okay.
All right, survey. Calling for the others before we start taking the photo. Marami
Eliza.
like ata sa group
Yan,
right
si Miss
now.
Liza nandito, si Paolo. Baka iba camera shy.
Hey, Miss
Yan.
Ebony.
Sige, we'll take a photo na, Alvin.
All right, sure. So let's start taking the photo at the count of, please smile, no? At the count of 1, 2, and 3. Are we good, Sir Ray?
Yeah, we're good.
Okay. So thank you again, everyone. So for joining our info session. And before we end tonight's session, again, CFA Society Philippines would like to thank our sponsors. Our platinum sponsor, Sea Oil Philippines Inc. Our silver sponsors, Video Capital, Coco Life Asset Management Company, and FTI Consulting Philippines. Our bronze sponsors, AP Securities Incorporated, DBP Daiwa Capital Markets Philippines, and Papa Securities Corporation, and our event partners, FMAP, Mart, and Sharefield. And this concludes our webinar. Accept our sincerest appreciation for your time and effort in participating in today's webinar. Again, to our speaker, Ms. Tony Bautista, thank you for sharing your knowledge. It's really been very helpful and informative for us, particularly to the audience. So thank you, everyone, and have a great night.
Thank you, guys. Thank